rate cuts will start in the US, and we're hoping that Mr. Powell makes that clear later tonight India time when that press conference takes place. So simply put, all the cues are global, all eyes on what the Fed will do as that two-day meet begins. So focus on the Fed meet outcome, Powell commentary, and what has happened overnight. The U.S. markets climbed for the fourth session post-inflation data that came out in the U.S. By the way, all three indices touched lifetime highs in trade. So the S&P, NASDAQ, all of them have done very, very well, but it is still wait and watch in that sense. Let's take a look at what happened to crude. Crude was an astonishing story. It came down about 4% overnight, did recover though. So just a little under $73 per barrel on the Brent. The 10-year Treasury down 7 bips to 4.19 odd. So a couple of things that are weighing on the minds of traders is that inflation data was in line year on year, so 3.1% year on year. That was expected. Month on month, it was 0.1%. Expectations were 0. So broadly in line with expectations. But remember, it's not close to the 2% mark that the Fed has outlaid for itself. And we're going to be talking about that in a bit more detail. But I would say that broadly, those are the big cues that the world is looking out for. Niraj, the question, though, is that the overwhelming sort of story or idea here before Indian trade as well?
You would argue, yes. Also add to that the fact that the CPI numbers looked very solid. Cap goods within that, very, very solid. So everybody's talking about the CapEx theme. Pranjul Bhandari, I was talking to, was talking about how the bank credit is at an astonishing multi-year high. And that augurs well. I mean, that typically happens not when retail happens, but when corporate happens. And if that were to result into private CapEx as well, all fingers crossed for that. At some point, the government CapEx will ease off. So yes, IIP, CPI, US numbers as well looking okay. One hopes that that certainly plays out, guys. But yeah, I mean, the interesting thing was yesterday we were talking about this in the trade setup as well. You were also mentioning that the rate sensitives took a bit of a step back yesterday. We saw profit booking in autos, we saw profit booking in real estate, certain PSU names as well. So we saw the market, which was very active for the last few days, starting to look a little bit maybe not skittish really, but taking a bit of the profits off the table, if you will. And we saw clear signs of that yesterday, both on the derivative markets as well as in the cash markets. There was a pullback that was seen in trade yesterday. And frankly, I mean, we were talking about these quant indicators indicating that there might be a pullback that could happen. Yesterday was the first day. The market remained ripe for some more pullbacks to come in if indeed there are bad news. I mean, excuse me, but if Jerome Powell does not sound as sanguine or as dovish as the market hopes he will, then you might certainly see some bit of a pullback coming into the global markets and thereby Indian markets too. But I think the jury is out there, and Samina and Tamanna will speak a lot about that, so I'm reserving my thoughts there. The metals rally has looked strong, courtesy what China said in its Politburo decision in Friday. 3 days on a trot now, we've had metals rally. Could they stop? Maybe. And therefore, when you talk to any dealing room worth its salt, the unequivocal favorite is financials. Everybody's saying one pocket to buy if there is a dip is financials, and maybe therefore people would largely focus on that. Intermediate rallies in metals, in autos, etc. continue, but that one strong pocket that everybody says is financials. But I must say, just one last word on the trade setup here, the kind of money that is chasing stocks, SW Solar QIP, J&K Bank QIP, the kind of response they got. And I'll talk about in the stocks to watch as well. But an SME IPO, guys, 78 crore IPO, got subscribed 362 times. It's just the quantum of money chasing stocks out there. One word for it, madness. It's just crazy.
I'm going to build on that point of yours, and I recently saw a couple of funds. So you're even in the unlisted space. So what I'm trying to indicate here is while money is chasing listed equity, there's enough and more free money, cheap money in the unlisted market space. We'll talk about Axis Bank and Bain Capital in a minute, but Bain Capital has recently also launched another fund where they're looking to raise either local or foreign money. It'll be interesting to see because a lot of that will be finding its way into Asian emerging market sectors. So yeah, the focus is good money, cheap money, free money. You can call it what you want. That is galore. Niraj, Tamanna, I want to come back on the IIP number and the inflation number. So while inflation, we did see surge a little bit on back of vegetable prices, commentary is indicating that this may not just be transitional, right, or transient in that sense. If inflation inflation does remain high. I'm not sure what that means for the Indian economy as well. I don't think we're expecting any rate cuts anytime soon. So that is one thing that I'm a little concerned about. So while growth is looking good, you've got manufacturing, electricity, all those numbers are showing up pretty well. Inflation on vegetable prices, the kharif crop may not look as good. That could be some concerns that we could be staring at, especially talking about negative news points if you're going to look for those in the next couple of months.
Absolutely. So just to come on that, there has been a lot of push, just to add to the food inflation bit, to control those prices.
Yeah.
So when tomato prices went up, the government cracks down
on the
very
hoarding,
quickly. Same with onion prices. In fact, the Consumer Secretary was talking about it yesterday. They've done that with sugar, which is why sugar stocks are, feeling that pain. So the only positive side to that is that remedy is also quick enough.
So they're prepared for it.
Yeah,
I think that's probably the better way to look at it. But talking about the markets, Niraj did indicate that let's actually take a look at GIFT Nifty. That's the first thing we should be doing this morning, indicating to a marginally positive start. A flat to positive is what we are expecting. Remember, in yesterday's day of trade, the bears were in control of the street. The breadth of the market also was fairly soft. This morning, Asian markets are trading mixed. You've had some commentary coming in from Japan. So the Japanese yen too is in focus. Like you can see, Japan is the only market that's outperforming the rest of Asia. US markets also had ended on a positive note. Tamanna has indicated what crude is also getting up to, so that could be a lead indicator for what could be setting up us for trade in this today's session. Let's talk about a few stocks that could be in focus. Axis Bank is one that you want to watch out for. Not sure how well or whether or not you will see a big reaction on the counter, but this is an important news point where Bain Capital is looking to sell 1.1% stake in the bank. They are looking to divest about 3.34 crores shares. They will do an offer stake sale at a floor price of 1109, which is at a discount price of nearly 2% to yesterday's closing price of 1131%. Remember, Bain Capital's minority stake is valued at $444 million. This comes in after they've done a stake sale of 0.75% in the month of June. That did take place as well. Post this, Bain Capital will not hold any more stake in Axis Bank. Ashish Kotecha was a Bain Capital nominee on Axis Bank, who was nominated in December 2021. It will be interesting to see whether or not Ashish Kotecha will also step down from Axis Bank. But watch out for the stock. It may see some pressure on back of this news this morning. Apart from that, you've got Indian Bank. Relatively small stock, but worth the mention. They're opening a QIP for raising 4,000 crores. The floor price has been set at 414.44 rupees a share, which is at over a 5% discount to yesterday's close price. The last QIP was undertaken in March 2021. What we also believe is the QIP could open 5% lower than the SEBI-approved price of 414 in the price range of 397 to 400 rupees, which is about 10% lower than yesterday's close. Another big one worth the mention, and this will be talked about for most part of today, is going to be ITC. Analysts board meet concluded yesterday. This is what the key takeaways are. Management hopes for a stable tax regime, and that is going to be critical for their cigarette business. Management is also expecting regulatory actions to curb illegal volume. Volumes of cigarettes are expected to see a recovery of 0.9% from their FY13 base. So interesting. It largely seems positive. Brokerages are looking optimistic on this one. I believe Niraj wants to come in on ITC.
Just two quick points there. One, they made a very interesting point about rural demand bottoming out. So that is very key. And 80 to 100 basis points YOY margin expansion on cards. On that base for ITC to do that is stunning. So the, ITC right up there, Samina and Tamanna in our scheme of things today, certainly a stock to focus on.
Indeed. We'll see. It'll be interesting. I don't know, Niraj, in terms of the movement, this is a big name. It's not going to be a small counter, but also it's a big news development in that sense. We are going into a day when trade might be soft, so the market breadth may not be in favor of the bulls this morning. Keeping that in mind, you guys still think ITC could be seeing a big move?
It hasn't, and the entire FMCG pack has sort of sat out the momentum that we've seen. But just this point that if rural consumption is really going to move up, and that's been a persistent issue with all FMCG companies and their commentary. Consumer staples, analyst after analyst has come here and said they do not like consumer staples because the up growth is not there. So my move is that perhaps not too much will come in on ITC. Do you differ on that?
Maybe the proxy could be playing smaller.
No, anybody's guess, but just the fact that rural demand plus margin expansion for a business which, after having a really rah-rah run, has kind of stayed on the sideways, could be an interesting day today. Let's wait and watch.
Absolutely. Well, a few more stocks that are on our radar this morning, and I'm just going to take off from that fundraise story. And public sector banks raising funds has been such a phenomenon recently. So I'm just going to talk about Bank of Baroda. Their capital raising committee is going to be meeting on the 15th of December to discuss fundraising. Bank of Baroda has also run up a fair bit. Yesterday was about 0.5% up in close. Jammu and Kashmir Bank is another one I want to talk about. That was kind of a star of the day yesterday and closed about 9% up. They will be having a board meeting on December 14th also to consider a fundraise. A couple of pharma companies that have news flow around it. Shilpa Medicare, one of them, they've got an approval from TGA Australia for manufacturing, packaging and testing of an oral mouth dissolving film. Essentially what is used when you have sublingual medication, which you put under your tongue. That product is already being sold in US and other markets, so that might see some kind of an impact for Shilpa Medicare. Laurus Labs had a slew of FDA inspections in the first week of December. Now 5 observations have come in post that at their Andhra plant. And I would just mention maybe Mahindra Finance. So Jefferies note this morning, which maintains a hold rating at 295 target price. There was a management meeting, and the takeaways from Jefferies is that they're positive on H2 loan demand, on rural infra activity pickup. So one more sort of broader theme on rural infra coming in, or rural activity coming in there. They're going to enter digital small ticket lending segment, and NIMs can inch up 20 bips to 6.8% by March. So maybe M&M Finance being added to the watch list this morning. Where would your list, what would your list look like, Niraj?
Yeah, it'll be interesting to see. Laura's, Tamanna, you're right. Just the fact that because while we don't know the nature of the observations, we've seen what happened to, I think, Dr. Reddy's, one of the days wherein, the nature of the observations notwithstanding, the stock took an initial hit. We've written to the management. Let's see what they have to say about the nature of the observations. So that is one. And we know what happened to a stock yesterday on a rumor. PI Industries, we were talking about it, and the stock was down 10%.
You're going to be speaking to them today.
Yes, today.
That's one to look out for,
at 11. But the management clarified on other media houses that, or one media house, that the conversation of Rainbow coming in, setting up capacities and impacting the business, the fears are exaggerated. You never know. On back of that, we might see a bit of a pullback in the initial half of already. But yes, looking forward to that conversation with PI. A couple of other stocks, Z, we haven't given graphics for that, but Plutus Wealth Management bought in significant chunk at 292. So Z is rallied quite a bit already. Let's see if there is more in store. And OFSS might be in focus because the parent, Oracle, was down 12% post-weak earnings in the global market. Let's see if there is a collateral damage to Oracle Financial in our markets. Last couple of things. One of them is Sigachi Industries. It's a 1,600 crore market cap stock, not very high. But look at the money raise that we're talking about. Axel Microcell IPO, it's an SME IPO, got subscribed 362 times. It got about 15,000 crores worth of bids for a 78 crore IPO or thereabouts. Now, the reason why this is important for Sigachi, because Axel is a competitor of Sigachi. So watch out for Sigachi in the session today. If so much money is chasing a new kid on the block, who knows, there might be some impact on Sigachi as well. And lastly, something that we do every day, which is stocks which have got some very interesting price and delivery data, more importantly, being very high. So Chalet Hotels yesterday was up 4%, but the delivery volumes, 13.8 times the 1 month average. JBM Auto, up second day on a trot, 5%. Again, volumes 12.5 times the delivery versus, not volumes actually, the delivery volumes at 12.5 times the 1 month average. Safari, we spoke about this stock yesterday on the closing show as well, 8.75% higher, 2.7 times the delivery volumes. And Sonata Software was the other one, 7% higher, 6.1 times. So all in all, a lot of stocks it might well turn out to be a stock-specific morning.
Another two sectors to watch out for could be sugar and anything that is crude related. So those two areas again could see activity in opening trade. Whether those gains or losses will sustain through the day is going to be anybody's guess. But eye out to play crude proxy. Usually news dependent. So of course, no material moves will come in, but intraday activity picks up on counters like OMC, paint companies, tire companies. Anything that plays crude proxy could be activity based in early trade this morning. I think those are the other names. And also sugar, another space that we've talked about all week. Beyond crude as well, there could be
some decisions in the offing.
We've checked the filing. Nothing's come in just yet, but I think we'll all be keeping an eye out for what comes out.
So we've been reaching out to the management of various sugar companies, and they say that there's so much uncertainty, let it all settle. So let's see what comes up. But just before we wrap up the trade setup, I want to point out to two IPOs, because IPOs has been such a flavor of the season. Two open today, so a quick word on that. DOMS Industry is one of them. The pencil makers public issue opens today. They're raising about 1,200 crores. Price band is 750 to 790 rupees per share. India Shelter Finance Corp is the other one that opens today. It's an affordable or small ticket housing finance company. So that's their play. 1,200 crores is what they want to raise as well. So both of them, 469 to 493 is the price range. We also have heard from the DOMS management, and you'll hear that later on this show.
Yeah, very important, and you know, I'm glad we rounded up with the IPO thing, but it's 8:17, time now to get in the editor's cut into the picture. So Alex, what do we have on the editor's cut today?
So normally we look at stock-specific action, but I think you can't ignore, Niraj, you can't ignore the Fed today. That's going to be what global markets are going to be focusing on, and of course on the back of the inflation print for the month of November, and that came in more or less within expected lines. We spoke with Julius Baer and we spoke with Mark Matthews of Julius Baer this morning, and the jury is out as things stand of what the action is going to be in 2024. I think broadly we're expecting a pause this evening or this night, or tonight, but we're talking about the context, of course, and we're also talking about BSE, by the way, because this stock is up close to 6 times in just this financial year. Agam is going to talk about why that is and what the prospects are going forward on the fundamentals. Let's start, ladies, with the conversation about the Fed. Tamanna?
Absolutely. So no prizes for guessing that this is the biggest event in the last few months. In fact, markets have been running up incessantly, betting on what will happen tonight, India time. And the question is whether those bets have paid off or did they get ahead of themselves. So we're calling this may or maybe, because the large scale trader bet is that May is when the rate cuts start. But maybe Jerome Powell has another thing in mind, because remember, on the 1st of December, he said you cannot assume that interest rates are done or interest rate hikes are done, and that really spoiled the mood. He said, in fact, let me quote it, "It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease." Now, the inflation data that came in yesterday is also not making the picture too clear, because yes, the year-on-year figure is as expected online, but 3.1% is not 2%, which is what the Fed is very clear about. So being better than the highs of inflation is fine, but is it good enough? Plus your month-on-month figure is just an edge higher than expectations. So we don't know what is going to happen, and just so much hinges on this decision right now, which is why it's very, very crucial to look at. Samina, a lot of impact on what dollar and currency will also do.
In fact, Tamanna, the Fed, and Alex, Tamanna, the Fed has never said that they're cutting rates. All we've said is we're looking at data points. Now, the markets can read this one way or the other, like you've said, but if you look at what traders and Fed futures are indicating, they're very clear that they're expecting aggressive rate cuts as early as May 2024. We should be getting 100 basis points all through 2024. So that's the sort of sense expectation that we have. But if you take a step back, risk on trade is very evident for all of us to see. So rate cuts have already been baked in. Equity markets in the US have rallied up in the month of November. In fact, we've had one of the best Novembers historically for US equity markets. The dollar has been looking fairly soft, which makes me believe that there is an expectation in the dollar index or currency markets that a rate cut is almost given or baked in. If that does play out, what does that do for gold? Gold will actually get stronger. Metals have been rallying across commodity spaces all over the world. So that is another indication that there is an anticipation. Now the point is that the Fed says even a little of this could be viewed as an other injection for risk on trade to play out, right? So if they abide by what the street is expecting, it wouldn't surprise me if equities continue to move higher from these levels.
On the flip side, and I'm saying that because we've had global voices on our program in the morning, on Monday as well as today. By the way, Mark Matthews stating very clearly that he is in the camp of expected cuts in 2024, but he expects it towards the latter
second half
part
of the year,
and only 50 basis points. By the way, not a very significant cut. Earlier in the week, we had a global voice saying he does not expect cuts in 2024, and he thinks that the yields are too low at this juncture. They could rise, and if that happens, there will be
so you might get a rate cut. The timing of it is debatable, but I think Goldman also said this. They said there could be pain in the bond markets. So before you see this rate cut, there will be a little bit of trauma that bond markets will feel. And let's not forget, right, real interest rates in the US have eased off, and that's the other, or rather have risen, and that's the other reality, right? So the fact that inflation showed you the numbers it did, consumer spending, business growth, those things are already seeing an impact. Jobs data.
Exactly. So just on jobs data, so the interesting, the anomaly there. Unemployment rates are low. So that's telling you. So that's telling you that the U.S. economy is doing well. So now what's going to happen to inflation? But hourly wage numbers did not move. So that's telling you, okay, maybe it's not such a big problem. So there's so much confusion on what this data says. We're waiting for Powell G to tell us.
I don't think any of us are envying his position at this stage, right?
No,
he's got a thin line to walk. Talking about him, you've also got Bank of England and ECB to watch out for today. Not very critical for equity markets, but be a very exciting day for traders in the currency markets, I'd imagine.
So I guess the bottom line and the outcome of this conversation is that the jury is still out. Of course, you might just get some clarity in the statement later today. Don't expect too much about what will happen in 2024, though. A pause is what is expected. And of course, the Fed will likely say that they will continue to watch the data. It could, in fact, have both effects, right, as we talked about, and bond yields are what it hinges on. Let's talk about something that we are a little more certain about, which is BSE and the stock price, and the reason why it is where it is right now. And Agam, you have some details.
Right, so I'm here to actually question the kind of rally the BSE has seen of late. Staggering valuations at this point in time, just hit a life high about a few days ago. At this point in time, it's trading at around 61 times FY24 earnings. My question is, and it's not like we don't have enough stocks which are in fact trading at those levels with the kind of growth rate that BSE is expecting, but with respect to keeping in mind its peers, it certainly seems very, very expensive at this moment. Now, before I start talking about valuations, let's consider why we've seen such a sharp rise in BSE and the share price. One is a 25% CAGR growth over the next 3 years, all the way through FY26. Its key segments like Star MF as well as listing along with transaction segments all have done staggeringly well, strong growth coming in. In fact, the Star MF segment has seen about 50% growth on a year-on-year basis for the first half of this financial year. But perhaps the most important factor which is playing in favor of BSE is that they relaunched their derivatives segment, that is BankX and Sensex, back in May. And that is getting substantial amount of traction. And in fact, they're expecting their average daily turnovers to double over the course of the year. Now that brings me to the question of valuations. Sure, BSE has run up, and at the moment, it is trading at 64 times price to earnings FY24. This is twice as much as its previous 5-year average.
Wow, okay.
Naturally, we're going to compare this to NSE, and also I know that NSE is unlisted. But in the unlisted space, NSE is going at somewhere around anywhere between 3,700 rupees to 3,900 rupees per share. And that comes to a price to earnings ratio of 20 times, assuming a 30% growth. If I give 30% growth to BSE as well, BSE at around 64 times. So that's still 3 times more expensive than NSE.
On NSE, right? They've talked about a listing.
Yeah.
Now, when that happens, it's going to be anybody's guess.
And I'm pretty sure that once it does get opened up, Samina, that multiple is going to go through the roof.
It indeed will. It's pretty much, I believe the valuations of NSE stand at the value the real estate NSE actually owns at this stage. So it doesn't even factor in the outlook, the potential for the kind of business that we're looking at, the growth that NSE or BSE for that matter, which is what I want to talk about today.
Yeah, and also the question of availability. Right now, if I want to participate in, this stock market surge in India and investor surge in India, this is my only option.
Absolutely. So
I mean, of course, there are other brokerages as well,
That's commodities.
I mean, compared to, as an exchange, compared to NSE, I don't have NSE as an option.
100%. So NSE at this moment is only limited to high net worth individuals because last year we had some limits put on as to what is the minimum amount any investor can buy into NSE shares. Plus, you have to register with the exchanges in order for you to go ahead and, in fact, buy NSE shares.
Just to reiterate that point, while there are HNIs who are willing to pay this premium, stock is not available. People are unwilling to sell even at a massive premium. So, talk about levels over 4,000. You just don't have sellers in the market at this stage.
So therefore, artificially controlled supply. And on the other hand, for BSE, there is a scarcity premium at this stage, which maybe some would argue justifies that multiple.
Yeah. So let me come to the scarcity premium. Let's take examples of DMart, which is trading at around 90 times. Let's take something like a Coforge, which is trading at around 30 or 40 times. The free float for these companies is at around 9.5–10%. On the other hand, BSE's free float is at 84% comparatively. Okay. So there is a substantial amount of supply out there to play around with. And my question is that there is no reason for that scarcity premium for the BSE to enjoy,
which is about 330% year to date.
Yes. So
how would it compare to MCX? Because that's another exchange. I know it's commodity focused, but the rally there has been what, 80% this year?
Yes. The reason why I wouldn't want to compare it with MCX is because first, when it comes to price to earnings, MCX price to earnings looks staggeringly high because they put in a lot of investments in their new platform. Secondly, MCX is focused in commodities. Whereas BSE
the volumes would be significantly different.
Yeah, completely different. Yeah, so apples, oranges comparison. So maybe for this case, I'd leave MCX aside, but NSE and BSE would certainly be a more pertinent comparison.
So therefore, I think the bottom line, if you can allow me to use that line, is that the jury's out on whether or not BSE will rise from this point, and perhaps we should ask our experts through the day what they think about what you should do with BSE if you're holding right now or if you're thinking of getting in. But that was the perspective on why it has gone up so much. We are at the end of this particular segment, which is, by the way, the editor's cut. But there's lots more that you need to know before the start of trade, starting with the latest updates in the F&O space. So do stay tuned for that. We'll be back after a very short break.
Welcome back. You're watching India Market Open. Before we move ahead, let's just take a quick look at the top headlines at this hour. All eyes on global cues today. U.S. inflation is in line with expectations. Will the Fed provide clues to a possible rate cut in 2024? Meanwhile, GIFT Nifty hints at a positive start. Asian markets trade mixed. Crude oil falls 4% overnight, then recovers. Outlook is bearish on oversupply and demand concerns. Back home, inflation rises to 5.5%. Good news for now, but the risk of food prices rising remains. And the Adani Group has committed to invest $100 billion on energy transition over 10 years. This in order to achieve its goals and meet its ESG goals. All right, let me go across to Agam now. Bank Nifty expiry, weekly expiry today. What's the setup looking like? Is that nervousness, trepidation showing as well?
Well, it certainly seems like there's a bit more consolidation on the cards at the moment after the kind of up move that we've seen in the benchmarks last week, and perhaps now is the time where we are looking at a little bit of sideways movement. In fact, a little bit of negative bias as well, seeping into your key benchmarks. As far as the Nifty goes, 0.5% cut, not too much change in open interest, about decline of around 2.5% in open interest, in fact. And as far as the Bank Nifty is concerned, while the index did come off by about 0.5%, we saw very little change in open interest. This also indicates that traders are perhaps at the moment hesitant to, well, put in more in terms of their positions. They want to wait for more data, more cues to come in before they, in fact, take a view on the direction of the markets. As far as the options market goes, and as you can see, the 21,000 call is the one with the most amount of accumulation in open interest, and it is for now serving as a little bit of a resistance, and as far as your puts are concerned, we really don't have too much accumulation there. And speaking of that, let's also take a look at how things have panned out yesterday in terms of changes. So as you can see, a lot more writing around the 21,000 and 21,100 calls, and not too much action as far as puts are concerned. So we are seeing that resistance building around 21,000, 21,100, at least at the moment. Let's talk about stocks then and see where we have, in fact, seen an increase in open interest. So PI Industries, of course, will be in focus. We have a lot of broking notes which have come out as well. We saw some shorts building up there, and Bandhan Bank. And besides that, longs coming through for Ultratech Cement, Granules, as well as HDFC Life. And in terms of stocks which saw unwinding in open interest, well, it was, in fact, longs unwinding across for Coromandel, SAIL, ONGC, Polycab, as well as Sun TV. So that's how things stack up for stocks. But as Tamanna mentioned, we are keeping an eye on the Bank Nifty today, the weekly options expiry. We are comfortably above the mark of 47,000. And the question is, where do we go from here? And can we expect volatility to return, perhaps an expansion in premiums as we move into today's weekly options expiry? But on that note, let's get in an expert. Let's get in Soni Patnaik of JM Financial, who can perhaps take us through what she makes of this data and how she's playing these, well, strategies here. Soni, good morning and thank you so much for joining in. Let's start off with your view on your benchmarks. What are you making of these markets?
Good morning, and thank you so much for having me on the show. Rightly, you've already pointed out, we've seen very heavy call writing aggressively taking place at 21,000 call option. In fact, if you look at the put call ratio of 21,000 strike alone, it has dipped drastically, from 0.6 to below 0.4. So it is indicating that, expiry should be below 21,000 by tomorrow. And on the downside, of course, there's a good support at 20,850. It's a technical support. It's just, we should not even forget that both the indices, Nifty or Bank Nifty, they are in overbought zone. So a corrective dip is inevitable at this point. Any corrective any corrective dip that we see in Nifty over the next few trading sessions towards 20,700, 20,600 can only be used as an opportunity to reinitiate your longs. So one must book your profits at current levels, or perhaps trail your stop losses. Wait for that corrective dip to come, and then you can reinitiate longs. So I think that's how the entire Nifty structure is going on around. 21,000 looks like a very strong resistance for tomorrow's expiry. Talking about Bank Nifty, I think Bank Nifty at the moment it is sustaining above 47,000. But if it were to give a expiry today below 47,000, you can see some further a small dip around 46,500 to 46,300. So that's a range where Bank Nifty should find a support. And you can use that support, to just re-enter or reinitiate your longs again. Overall, the undertone for both the indices remain bullish. However, because both the indices are quite overbought, a small corrective measure, a small correction, healthy correction, would be quite nice for anybody who's missed out on this rally so that they can reinitiate their longs again.
Right. So, Soni, at the moment, you are playing a credit spread on the benchmark. Can you take us through the strategy?
Yeah, definitely. So I think it's for Nifty I've given. So you have to sell 21,000 call option. Try to sell it in the range of 50 to 52. And to hedge the position, you can buy 21,100 call option. The total, if you can sell it in the range of most likely 21 to 23, you'll have a total premium inflow of 29 to 30 points. So this is a bear call spread because I just gave a view where, 21,000 put call ratio is below 0.4, the expiry for tomorrow's level is expected to remain below 21,000. So any moment you see the expiry happening below 21,000 is a profitable range. Even if it goes to 20,700, 20,500, it still remains the same profitable range of 29 to 30 points of premium. Your strategy is hedged if it were to go above 21,100 because, we've also bought the 21,100. However, it is advisable to put a strict stop loss of 21,050 in spot level. So if you see Nifty crossing 21,050 by tomorrow, it's advisable to exit from the strategy. And because, it would be exactly like no profit, no loss situation at that moment. So I think that's how the entire Nifty bear call spread is, we've structured for tomorrow's expiry.
Sure. Soni, let's move on and talk about stocks then. I believe you have a buy put strategy, that is a protective put strategy as far as Wipro goes. Can you take us through that one as well?
Yes, definitely. So we feel that, looking at the data, IT could be still outperforming for the next 2 to 3 months, and Wipro is coming at the cusp of another breakout if it were to sustain above 430. It's a reason there's a protective put strategy in Wipro. You have to buy the futures in the range of 425 to 422, and simultaneously you'll have to buy 425 put option in the premium of 7 to 8 rupees. So this will hedge your strategy even if the stock does not move as expected. Your break-even point on the upside is 432. So any moment above 432, you'll start looking at profits. You'll look at the profitable range. Targets for this strategy is when Wipro touches 450 to 460. So these could be two targets. The stop loss would be 414 on spot level. You can just put a cash level 414. If it goes below, then you'll have to exit from the strategy, both the legs, both the future and your put option.
Right, Soni. Well, thank you so much for joining us and taking us through your views on the markets and giving us a couple of ideas about how you can, in fact, go ahead and deploy these option strategies. And on that note, I'm going to hand it over back to you all in the studio.
Thank you, Agam. Just a quick one, a GIFT Nifty check as we get into setting ourselves up for trade this morning. It is looking like a flat start. Remember, yesterday the trend was fairly bearish. F&O data also indicating that the markets seem to be in overbought territory. We have with us Niraj Shah, Head of Equity Research India at William O'Neill. Good morning, Niraj. Thanks for joining in. First up, are these markets looking expensive now?
Morning, first of all. It's a pleasure to be in your studio. I think it's a wonderful setup and pleasure to be here. So two things. One, the expectation in terms of earnings growth for the next financial year, largely pegged between 13 to 15% and the year after that a little bit lower. So if you go by the consensus in terms of how the Nifty EPS is expected to get placed for the next financial year, close to around 1150, 1175, which basically means it trades around 19 odd times, which is an average of the 1623 times that the Nifty has traded in the past 10 years. So not overly expensive, not overly cheap, fairly valued. I think the risk reward is in favor of India.
Yeah. The question is, what happens over the next 48 hours and how much does this matter to this overall very bullish mood Absolutely. Yeah. But we're waiting for a key sort of indicator coming in from the Fed. Can it spoil the party if, the Fed, of course, continues to pause, but does not seem like it's in a hurry to cut rates? If Mr. Powell comes and says that, when did I say I will cut rates? Let's wait and see. It's not the right time. How sensitive are we right now to that cue?
So I think that is one deciding factor which will decide how long this bull market will continue for. But largely, I think the space that India is at this juncture, largely the expectations of a rate cut in the second half of the next calendar year is largely penciled in. Now, to answer your question, if that probably gets delayed,
that's our rate cuts.
The Fed rate cut.
Fed rate cut.
And we will follow suit as the Fed starts cutting. But to that extent, a large part of that has got priced in. Now, the upside risks, because we do keep an eye out for the risk factors in the market as well. The upside risk will be if this continues for a longer period of time than expected. Maybe the markets over the next quarter will start feeling that part of the heat. And what is happening with the banks? Because a large part of the US regional banks are feeling the heat as far as the M2M bond losses are concerned. What's happening in China, if there is a significant hit on the bond portfolios as far as banks is concerned, maybe that has to be taken as a write-off for most bank balance sheets. And therefore, that is one risk factor that we are probably watching out for, which can have a sort of a global effect, and our markets will also get affected by that. Are we overly perturbed at this point of time? Not really. I think we are waiting for a correction. The unfortunate part is when the correction comes, very few people jump in.
Or very few people have the money.
So I think retail investors have relatively become far more smarter, Tamanna, over the last couple of years as we've seen. SIPs have continued. A fall in the market would be a welcome sign because that will give better entry points for most sectors, most stocks. But structurally, I think a large downside risk for the markets, irrespective of what the Fed does or not, is relatively covered by the markets. Our markets are on a different trajectory as far as consumption patterns are concerned. You have a look at the ITC presentation. One of their slides on the macro front is very, very interesting. What they have put forth in terms of urbanization, in terms of the urban to rural mix, and in terms of expectations of our GDP. We've seen this in the past. We are already around $2,400. Once we touch that threshold of 25, an inflection point as far as consumption is going to start a huge cyclical consumption story as far as India is concerned.
No, this is interesting. And by the way, we should get our colleague Mahima up in about a minute to talk about that ITC presentation since Mayuresh has brought it up. But Mayuresh, since you've brought it up, and we'll come to ITC as well, but the takeaways from the ITC presentation, wherein the point that you mentioned, the point that they are saying that we are at the rural seems to have bottomed out. And we know that rural has been the pain point over the last 6 odd months. Does this augur well for companies exposed to the rural market? We've seen two-wheelers make a bit of a move, nothing dramatic, but a bit of a move because the valuations have bombed out. Do other rural stories come up over the course of the next 3 to 6 months?
They would, and as you rightly pointed out, I think that is the appropriate timeline for those stories to probably get invested in. What you've probably seen in terms of FMCG volume growth has largely been over the 10 years around 3.5% odd. The expectations in terms of rural consumption is almost 2/3 as far as FMCG companies are concerned. And therefore, the ideal mix that they want is an uptick in rural and semi-urban consumption. Urban consumption largely sticks around. In fact,
I know. Samina and Tamanna keep on talking about shopping every Saturday, so I'm not surprised. Me too. Sorry. I'm not being sexist here. I'm not being sexist here. Tamanna can scare people, I can tell you that. But sorry, the point you were making.
So it happens in every urban home, I think. So to that large extent, urban consumption is expected to still continue at a very steady pace. And therefore, the direct reach that FMCG companies want to probably have an aspirational target towards, the expectations in terms of more discretionary spends coming with more per capita increases is something they would ideally like. Is that happening at this juncture? I think because of inflationary conditions, because of deficient rains, probably they are feeling a little bit more sticky as far as volume growth is concerned. And therefore, the next couple of quarters might be better entry points, not now. Valuation sky high, and companies probably might feel the heat as far as Q3, Q4 in terms of volume growth is concerned.
Okay.
Right. Talking about ITC and rural consumption bottoming out and margin expansion, that was the key takeaway from the analyst meet from ITC. We've got Mahima who's standing by with more on that. Mahima, what were your key takeaways? You've been through the report, you've heard what the brokerages have said. What is it that's catching your attention?
Right, Samina. So if we talk about the cigarette business, the management expects that there will be some kind of stability in terms of tax regime for cigarettes, and this will lead to volume growth in cigarettes, because volume growth in the cigarette segment has been subdued since FY13, and if we see in FY23 the volumes has recovered approximately 0.9x. So the management also expects that there will be some kind of regulatory actions to curb the illegal volumes of cigarettes that are being sold and produced. Also, they say that innovation continues to be in focus. New product development has in the past 5 years contributed approximately 17% to the volumes. So they also plan to expand their outlet reach to approximately 7 million. In terms of FMCG business, the rural demand has bottomed is what the management is expecting, and they now expect that the FMCG business will show an upturn trend in terms of rural consumption, and the management guides that they will increase their margin approximately 1%. In terms of non-FMCG business, they also see a lot of structural opportunities in the hotel business. There are 35 new hotels in pipelines. If we talk about the paper boards, the margins are likely to pick up in the next coming 1 year. They are tapping opportunities in the higher nicotine markets. They have also come up with the Mars platform, which is being used by 1 million farmers approximately in 9 states. And of course, their digital is the key. Digital market is the key focus, and they have enabled a 3 times jump in the digital market segment. So they continue. They want to continue to grow their digital segment as well. If we talk about the brokerages are bullish on ITC. Jefferies has given a buy rating with a target price of 530 with an upside of 17%. MK has given a buy rating with a target price of 525. So if you see overall, the focus is on agility, innovation, and investments, and overall cost optimization also.
Mahima, thanks so much for bringing that perspective. So that's ITC, what they have said, what the brokerages have said. Let's figure out what Mahesh Joshi has to say for that. Mahesh, ITC, we're not getting to buy, sell, hold, but I'm just trying to understand, is it a good investment candidate?
It is, and again, I think the kind of investments that they have pegged for the next few years, they've obviously pegged a stage 2, stage 3, where they have categorically mentioned which product categories they want to get in over the next few months, expand the hotel business as well. So there is going to be a significant amount of capex that will go into these new initiatives that they've probably got. Obviously, the free cash flows have been exceedingly good for the past 10 years, as they put in the presentation, almost 94,000 crores. But I think a lot of these free cash flows are now going to get back into these businesses. And that is where the market will probably again start wondering, when is the return on invested capital going to come, so on and so forth. So the typical story that ITC went through, a stagnation phase, maybe they go through that phase as they do these reinvestments back into growth. But a large part, is it a good story over the next few years? Yeah, it certainly looks like.
Just a quick word on other consumer staples. And they haven't really participated to the same extent, I would say, in the rally in the last 6 weeks or so. Any view that you're building there, anything that you like, or you'd stay away from the whole space as a whole?
No, so we are being very selective here, Tamanna. I think something like a Bikaji Foods, as an example, is something that we believe that there can be significant amount of volume plus value growth. What you've probably seen in these Indian ethnic snacks market is that it is growing at a humongous pace. And it is expected to grow because we as Indians love snacking in the evening. And to a large part, I think rural, semi-urban, urban, the kind of numbers are mind-boggling. Haldiram, Bikaji, the number of packets that they sell every day is humongous. So to that extent, relatively better balance sheet. You've got a reasonable amount of expectations of a double-digit volume growth. Margins expected to remain stable because input costs like edible oil, flour prices have probably come off and expected to remain a little bit benign. Q3 is where they'll capture the best part of Diwali and Christmas, and second half is always relatively better. So I have to pick and choose at markets with India. I think we like Bikaji Foods.
Yeah, and vegetables are expensive. You can always add some. No, that's completely. Manoj Valar also joining us now at Religare Broking. Manoj, very good morning to you. What are you seeing on the charts right now? We slid back below 21,000 on the Nifty. Where are those resistance levels coming in?
Good morning. Now, it's not only the charts, we look a lot into the quantum of data and also the quant analysis. So the equation that the market started the December series, excuse me, is there were short positions close to 60 to 68, 70 odd percent on the FIR desk. Now that has trimmed down to 40%. So the net long that the FIs have for this December series is around 60%, which is good enough. Now there is the most important thing what we need to understand is the amount of derivative position which was there in November. They get rolled into the December series. So that's not really a big move, because the money just gets rolled. The good part is if we see additional positioning which happens in the derivative side, and that gives a proportional rise into the open interest which happens into the Nifty. So let's say Nifty is almost at 1.3 crore in terms of open interest. So at least in the last 2 years where the FIs have been selling in the cash market and some buying in the derivative market. So that's exactly a reverse arbitrage way of taking out money. So that is happening since the last 18 odd months. But the good part is, at least on the DI side, we are seeing good buying, and that is taken the Nifty almost to this 21,000. There is more room on the upside. The good part is it is the bank Nifty which is leading this time, and there is a ratio between both the indices. It's almost at 2.24. So the bank Nifty has room till 2.27. So we are expecting the Nifty to be a buy on dips. The target would be 21,300 in the next maybe an 8 to 10 days. A better strategy is to do a bull call spread. This is a position trade that we are expecting. Buy 21,000 next week call option at 130 and you sell at 21,200 call option at 60. So the spread becomes around 70. The target is close to 150 to 180 on that. Now intraday, if you see Nifty futures has a good support somewhere close to 21,060. So that's a level we recommend going long on that. The stop loss should be, let's say, 60 points on the downside, 20,980 with a target closer to 21,200 intraday.
Niraj, I'm going to come to you on consumption because we were talking about that just before the break. Mass apparel is one space that's been pretty hot. And one stock that comes to my mind has to be Trend. I mean, look at those numbers from Zudo. They've gone from selling 500 crore odd in 2 years to about 3,500 crores today. Their strategy of selling everything under 999 and keeping our latest trends has augured really well for Trend. And then, of course, you add the likes of Star Bazaar to this. In consumption, if I've got to play the space, if rural consumption is bottoming out, how would you play the mass apparel leader Trend?
So it's done phenomenally well, no two ways about it. The numbers have been exceedingly good than what the street pegged or had put out. So to that extent, if you just extrapolate numbers for the first half into the second half, they're going to do humongous growth as far as FY24 is concerned. Now, will they be able to replicate that over the next 2 years at the same pace? I think this is what the street would now like to see, right? And therefore, I think what it is trading at, the valuations that it is trading at, will now try to pencil in a higher amount of growth for the next 2 years. Now, for some reason, if there is a dampening in volume growth or sales growth for this company across its product categories, there can be some issues as far as EPS numbers for 26 is concerned. So to that extent, is there momentum in the stock? Yes. Do we own it in our global focus list? Yes, as a compliance measure. But our valuation sky high at this point of time. I think they're penciling in the best that can happen in the next 2 years. Anything that goes wrong in a couple of quarters over the next couple of years, I think the correction can be equally swift and fast.
Right. Well, that's the view coming in from Niraj on Trend. He has iterated that he does hold on the portfolio, but the run-up has been sharp, which also could mean that if the stock does correct, it could be a one-way move pretty swiftly. Also moving on from there in an attempt to achieve its energy transition plans and meet its ESG goals, the Adani Group has committed to investing $100 billion on energy transition over the next 10 years. The group has set a target to become carbon net zero by 2050 or earlier for 5 of its portfolio companies. Himansh is standing by with more on that. Himansh, it's rare that we have a morning these days that goes without Adani being the big story. But again, big goals on ESG.
Right, Samina. And this comes in the backdrop of the government's increasing thrust towards sustainable and green energy. And Adani Group companies as a whole have collectively, committed to investing $100 billion, which is substantial over the next decade. And what we will be seeing is that they aim to achieve their energy transition plans and ESG goals as well over a period. Adani portfolio companies have outlined this recently in their investor presentation, and the group is set to, like you mentioned, achieve its net zero carbon emission target by 2050 or earlier. And the 5 key portfolio companies here that are in focus are namely Adani Green Energy, Adani Energy Solutions, you have Adani Ports, and then you have ACC and Ambuja. And if you go to see that all of these in the cap goods domain require lots of raw materials as well as energy consumption. So it's essential that they're mindful in terms of the way that they consume their energies here. Now, if I were to talk about the progress thus far, Adani Energy Solutions has increased its renewable energy share in the overall mix to 38%, and Adani Green Energy as well turned water positive for all of its sites with a capacity of 200 megawatts and even more, and they also achieved their zero waste targets. Adani Ports is on track to be turned net zero by 2040, and lastly, Adani Enterprises has committed to building, production of India's largest wind turbine. So lots going on for the Adani Group companies here.
Niraj, thanks a ton for that. A quick check on Gift Nifty before we slip into a break, indicating to a flat start, so not too much excitement expected in the early hours of trade. We'll take a break, we'll come back, but a lot more lined up on the other side, so stay tuned.
Back with India Market Open right here on NDTV Profit, and the pre-open rates have kicked in. Mild bit of an uptick, but these rates will be all over the place, so keep that in mind. We will, of course, get back to marking what individual stocks like ITC, PI Industries, HDFC Life, and some of the other larger ones have done. closer to about 908 when the pre-open rates have settled. But our guests are still with us, Mayuresh Joshi and Manoj Vayalar. Manoj, good morning. Niraj here, and thanks for joining in during our opening weeks. Manoj, I heard you talk about your index view. What has stood out rock solid the last few days has been PSU banks. Even in a day which came off yesterday, PSU banks as an index too was in the green. Do you sense some optimism there from a trade perspective?
Good morning, Niraj, and thanks for having me on the show. Now, the PSU and the private sector bank, they have a beautiful correlation which goes on with the bank Nifty. But unfortunately, if you see since almost September last year, this correlation has bottomed out. So the buying or the reflection of the positivity that we are seeing, the base of that has actually started in September, October. So almost it's a good 10 odd months that we have seen this. Now, if you ask me, is there more upside? Neither the net banking sector has a good positivity, because as I was saying, we are almost, if I have to just give you a bit more precise information, there is a mean correlation which happens between the Nifty and Bank Nifty, and that stands almost at 2.3 to 2.35. So we are almost at 2.24, which simply says that at least a 1500 to 1800 Bank Nifty points are still possible in the next maybe 20 to 30 odd days, post expiry also. So the target or the levels at which the Bank Nifty might seize, or this outperformance might stop, would be closer to only 49,500 odd. So we have a good 1,500 points at least on the Bank Nifty. And obviously, because the weightage of the PSU into the banking stocks is not more than a 20-24%, because private sector banks are more. So precisely, if I have to talk, should we buy now? I would still say stick to the large cap banks, because the alpha would be more there. But stock specific, let's say trading, there are other PSUs also, and a couple of stocks, especially in the power sector, where we are seeing good buying happening, and that is going on month on month. So Power Grid is one where, as a stock, where we are seeing good delivery-based buying, and that accumulation is very neat, which has happened almost from 200 to 205 level. The stock is almost at 230 now. The potential on the stock is almost at 248 to 250, which happens to be the target. The stop loss should be 216 on that.
Manoj, since today is expiry day as well, what would be your strategy at this point? We have, a big queue coming in from the Fed. So how would you play it? What would you advise?
Right. So if you see, I guess the currency market is open, and we have opened at 83.41 if I'm not mistaken. Right. So the reflection or maybe the anticipation is not much. But then what happens is when the trend is going on in an index like a Bank Nifty, which is expiry today, which has an expiry today rather, it is the option data that plays more role, because the Fed outcome would start really from tonight, and the reflection would be more in the next couple of days. So 47,200 is a good level where we believe that you can buy a call option of Bank Nifty closer to that level. When the futures dip, so 47,200, you hold it on for the entire day, and the target on that option can be a good 150 to 160 odd rupees. So if I just convert that into futures, you buy Bank Nifty closer to 47,200, keep a stop loss of maybe 100, 120 more points on the downside, and the target can be 47,480 to 47,500 intraday.
Right. Manoj, stay with us. Mayuresh, one topic that we discussed in detail this morning was BSE and whether or not we still see value in that stock. Sure. It's up 330% year to date, and it seems a little bit like NSE proxy play. So if you can't get your hands on NSE, you're trying to play the space through BSE, right? At this juncture, how do you view BSE? Are you constructive on it? Would you go out and acquire some if you don't already? And of course, I'm guessing your clients and you have access to the likes of NSE. So this discussion is a little more pertinent for the retail audience, I'd want to know.
So I think when you draw parallels and comparisons, obviously BSE has done phenomenally well. Again, based on the premise in terms of the new product launches that they've got, the optionality that BSE now has with a lot of more option trades happening. And therefore, the kind of moves that have come through are gestating a lot in terms of numbers, both in terms of expected turnover, the average daily turnover from new contracts and the products that they have introduced, and the annuity income that is probably far more stable. Having said that, if you go by the sheer size, I think the volumes on NSE, the expectations in terms of the different platforms and products that can get introduced over the next few months and quarters, I think the numbers will show a huge compounded growth. And therefore, it's always a classical argument, whether it's BSE, NSE, I think there are 2 exchanges in the country itself. But NSE probably remains something that can be on the radar of investors compared to a BSE. Right.
Manoj, hi, this is Samina on the side. I want to quickly get your view on metals. Stock like Jindal Steel were very active in trade yesterday, but the dollar as well is looking a little soft, the dollar index, I mean. How would you approach commodities this morning?
Yeah, so at least on the stock like the Jindal Steel, we believe that the stock almost at 740 to 45, it's a good level to go long. It has more potential, at least a target of 762 is what we are seeing. The stop loss here should be around close to 728. So like you said, yes, metals have been doing good, and we topped the list with Jindal and Tata Steel, but then today with the momentum that we have seen, we believe that Jindal Steel would give you a good 16 more rupees with a stop loss close to 720 as a stock.
Okay. Let's get some more stocks in news, and the pharma pack is in focus. Varsha, a list of stocks which are in news today, maybe active too. What's on the list?
So first we have a Mankind Pharma, where yesterday we actually saw a large deal of 7.6% stake in company, but buyers and sellers were not known, and today we have that data. So major PE investors have sold a combined stake of 7.61% at 5,588 crore. Now the sellers are Hema, CIPEF, then we have Karen Hill and Beach. The Kotak Funds India Midcap Fund has bought almost 0.5% at rupees 1,832 a piece. Now, Beach had acquired 9.9% stake in Mankind Pharma for an average cost of 540, which makes up a profit of almost over 3x on sale of its 4.46% stake, while Karen Hill would have made a profit of almost 6x on its 1.73% stake. Then we have Shilpa Medicare, where it has received approval from TGA Australia for its medical wafer manufacturing plant, and this unit is engaged in this is actually approved by MHRA UK also, and unit supplies oral film products to US and other markets, and this approval marks its entry into Australia market, and it has a pipeline of similar kind of products going ahead. Then lastly we have Laurus Lab, where it has its subsidiary Laurus Synthesis Private Limited receives 5 observation after US FDA inspection in its Vizag facility. The inspection was conducted between 4th December and 12th December, but company will address the observation under the stipulated time.
All right, thank you for that, Varsha. Quick word from Manoj on, I would say, the pharma stories that Varsha talked about. Mankind was, of course, block deals over there. We know now the details of who was selling. But Shilpa Medicare and Laurus. And let me start with your take on Laurus, because we saw similar kind of news in DRL. It got hammered day one, and then some amount of recovery. What are you, what is your play on Laurus?
Well, stock specific, even on sectors, we are very specifically focused only on the derivative trade, and I believe I would not really maybe trade into or volatile into that. But stock like granules, which is closer to 389, that becomes a better level to go long with stop loss of 380 and a potential target close to 396 on the stock from the pharma sector.
Mayuresh, what is pharma a little bit of a difficult play right now to figure out what to do with these companies, and what are you liking over here, if anything?
So pharma has become an underperformer of sorts, Tamanna, because of the huge momentum play that we've got in the market. But I think over a longer period of time, we're very choosy out here. I think what we're liking from the large cap stroke mid caps is Sun Pharma. Strong pipeline, and that can get monetized over the next 3 to 4 quarters or even beyond that. A large part of that pipeline is either in stage 2 or stage 3, which means the next few quarters, as approval starts coming through, these products will have far greater margins than the normal commoditized products. And therefore, Sun Pharma is something that we continue to like.
Okay, we need to slip into a break, but just marking crude beneficiaries, we're talking about them. Pre-open rates have settled. Asian Paints very likely will start off in the green, or is showing signs of starting in the green. PI Industries seems to be bouncing back a little. We'll talk to the management till 11 a.m. today. And Laurus seems to be starting off with a 3% downtick, so watch that stock as well. We'll be back from the break with the market open.
to India Market Open. We've got 2 minutes to go to market opening. Mayuresh, very quickly, one stock that you're constructive on right now?
So we're keeping the budget in focus right now. Welspun Enterprises is something that we are liking. It's a mix of both water, waste management and roads. And all the initiatives structurally that the government is taking, 45 kilometers expected every day over the next few years, if I may say. The kind of push that is happening towards water and waste management and the kind of allocations that have happened. Very strong balance sheet, working capital days are almost 3 or 4 odd. Very strong order book at 9,000 odd crores. They've done an acquisition by the name of Michigan Engineers, which is an expert in tunneling as well. And therefore, I think the balance sheet dynamics look very, very robust at this juncture as we speak, and stable return ratios expected. So Welspun Enterprises.
So that's Welspun Enterprises that Mayuresh is constructive on. But I'm going to quickly toss it out to Niraj. Niraj, it looks like it's going to be a quiet but volatile start this morning.
Yeah, very likely. For a change today, Samina and Tamanna, we'll probably see enough movers on the heat map, on the large caps on open as well. So it'll be interesting to see that. But as always, the action might be centered around the broader end of the spectrum. So you'll watch out for that. Remember, the currency's kind of steady as she goes. The barrage of inflows over the last few months haven't done much to budge the rupee. If anything, it's only been like sedately lower. So that's to be kept an eye out for. But in our markets, focus on pharmaceuticals principally. We'll also, of course, keep a keen eye out for some of those banks on which there are deals happening. And watch out for insurance companies because they had a big day in trade yesterday. HDFC Life was up 5%. SBI Life was up about 1.5%. About time they make a move. Let's see if they move today as well. But here are the first rates on the market open this Wednesday morning. Flattish for the Sensex and the Nifty. The Bank Nifty will come up on your screen next. Hardly any move there, and this was to be anticipated. Mid-caps about 1/3%. Let's see if small caps are starting off better as well, but 1/3% is not bad. About 0.5% for the small cap index too is not bad. Okay, so I stand corrected. Maybe the action will still be largely at the broader end of the spectrum. Tamanna and Samina will have a lot more to talk about than I do. Let's pull up the heat map nevertheless and just show you what the large caps are doing, and are there any significant movers on either direction. Not really. ONGC about 1% lower. HDFC Life marginally lower, Bajaj Finance marginally lower, TCS about 1% lower, but nothing to write home about. Almost even Stevens when it comes to the gainers and the losers as well. And on the gaining side, ITC, the analysts meet takeaways about 1% higher. BPCL marginally higher after that ex-dividend 4% downtick yesterday. And some gains for maybe a UPL, if you will, but that's about it. Don't see too many movers in the session on the large cap end. So quickly hand it over to Tamanna because maybe the mid caps have a lot more action. What are you spotting?
Well, it's a bit tepid this morning, isn't it? At least starting off. People are wondering what to do. I have picked ITC and we have it there, but just to spend a little bit of time on it because there's so much information coming in, a slew of brokerage notes, and that stock has shown signs of life after a fair bit. So 1% up over there. IREDA, I wanted to pull up because what a run up the stock has had. And yes, some profit booking there in IREDA as well. Still above the 100 rupee mark, but slowly coming down. We're going to be asking our experts ahead if there is any kind of entry point they see on a move like IREDA, which is just shot through the roof. Let's pull up our news-driven pharma company or medical companies. So Shilpa Medicare is one we spoke about, and they had a good sort of bit of news coming in. They've got an approval from the agency in Australia, the TGA, for their oral mouth dissolving film, which is used in sublingual medication. That's up 3%. Loris Lab had 5 citations. It's for a subsidiary, so might not really hurt the company in terms of revenues in a big way, but sentimentally, yes, it has been a negative. Something Samina was pointing out as well, that any bad news flow right now is going to hurt. So Loris Labs down 2.5%. The banks which are raising funds or planning to raise funds, J&K Bank, again, massive run up, 9% up is what it closed at. It's down 2% in morning trade, so a spot of profit booking there. Bank of Baroda will have a meeting in the next couple of days, will also plan to raise funds. That's, I would say, flat to negative. Indian Bank though, but doing well, up about 1.5% in trade. I just want to pull up Axis if we can as well and see what's happening with Axis. That news coming in on Bain Capital, which is going to sell a further stake in a fresh block deal. So if we can, we'll look at what Axis is doing as well. But yeah, a lot of news in the banking space, some smart moves there. But Samina, anything, headline worthy, like we like to say in the news business, that you're spotting this morning?
Stocks across the broader markets, Tamanna, that are actually holding up and looking good in trade this morning. The benchmark is soft, so no surprises there in terms of what you're seeing on the index. And the broader markets are largely moving in line with the benchmark itself. PI Industries, if you can pull that one up, the stock is one that we've talked about. We are expecting a slight recovery on it, and that's what's playing out. 1% high on PI is what we have. Crude proxy play is pretty obvious. So you've got stocks like all your OMCs, so apart from Asian Paints, take a look at Indigo. Aviation names also would be seeing some buying coming into trade this morning. 2% on Interglobe is what we have. HPCL, BPCL and IOC are also trading with a slight positive bias. Jindal Steel, heavy longs was seen on that counter in yesterday's day of trade. This morning, though, it trades the gain of about 1% on. I'm going to quickly mention a few other movers. So KPIT is seeing some action this morning. 3% high on KPIT Tech is what I last picked up on. There you go. 2.9% on KPIT Tech is what we have. Dixon is looking good. Nykaa is having a positive morning. Tire companies are looking good on back of crude plays. So stocks like Apollo Tires are also up about 1.5% to 2% in trade this morning. Midcap IT is trading with a slight positive bias. So that is worth a mention. A couple of sectors of gains this morning, and Midcap IT is featuring on the top list this morning. Apart from that, ITC, I don't know if we talked about that on the Jefferies on the analyst meet. Not a bad reaction. 1% gains. Remember, it is a heavy weight, and also what's important is that the sentiment is fairly muted on the street. But despite that, taking room and heart from the comments that came out from the analyst meet, ITC is trading with a gain of nearly 1%. Z as well, there was some big shares that changed hands. On back of that, the stock trades with a 1% gain. Trent is one we've highlighted this morning. Again, 1% high on that counter. So, Tamanna, Niraj, the broader markets are also trading quiet. Some pockets of interest. I think crude proxy is looking good. You've got your aviation, oil and gas names trading higher. I think Midcap IT as well, with KPIT leading the pack, is having a good day.
And with reason for KPIT, with the technology that they've launched, and who knows, they might be amongst the key technology providers for new age cars as well. But opening thoughts, Manoj, before we thank you, a quick word on how have you seen the open, and is there any change in amongst the ideas that you recommended? Would you want to replace them? Would you want to add a new name because of the price movements that have already happened?
No, not really. On the Nifty side, even yesterday, if you see almost at 20,900, the bounce was quite swift. Now, obviously, because of expiry on the bank Nifty today, we would see some option writing happening. So we believe again that this 47,200 on the future should act as a good support. So closer to that level, that is where on the futures we expect buying a call option, and intraday we are expecting a good 200 to 250 odd point bounce on the bank Nifty today.
Right. Manoj, Amirish, what about you? What do you make of today's opening? It's a flat start, no surprises there. I think we are in a month when usually flows seem to ease off. Your FPIs will be closing books for the year, so not too much activity anticipated, right?
Yes, absolutely. And in fact, from the coming week, I think it can be a little bit of a frenzy as far as broader markets are concerned. FI is out of action, I think.
And we already celebrated Christmas a few days ago.
Exactly. So the broader market will still remain in focus.
But, don't forget the role of domestic flows now increasing more and more. And we're seeing that kind of buying coming in as well. I just want to get your sense on the kind of broader theme that we're seeing in terms of autos, if you have a view at all, Mayuresh, because even this morning in trade, a decent kind of a move in the auto pack as far as Nifty companies are concerned, when everything else is a little blah. Eicher, Hero Moto, M&M, all doing fairly okay. So do you think that you would be positive on this space? Two-wheelers catching up, perhaps you'll have tractors catching up, and passenger vehicles have already shown a fair bit of robust numbers. Is there an upside now further?
So I think the prices have already caught up significantly in the last 3 years. And it is penciling in a significant amount of volume growth. So structurally, yes, remain positive in terms of the auto sector dynamics. But auto ancillaries is something that we remain focused upon at this juncture. So within the auto ancillary pack, the battery makers, an example, Exide, Amara Raja is something that we like, specifically Exide at Markets with India. The logic here is that the transition as it happens from the internal combustion engines to the electrical mobility platforms, these guys are geared up pretty well. So they're putting up the plants in terms of the lithium-ion battery manufacturing capabilities and capacities as well. And they're servicing the existing clients, both the automakers and the industrial part as well. And let's not forget the replacement part of the market, which is the strongest part in terms of the margin profile for all these companies that are involved. Balance sheets are pretty strong. And the expectation is as the transition happens, they'll have the best of play of the transitionary impact from the original makers as well as the replacement market. So I think auto ancillaries is what we remain steadfast upon.
Anything apart from Exide and Amaraja? Any names there?
My typical favorites, Minda Industries is something that I continue to like. I think it's an appropriate mix of how the electrical ancillary mobility is probably going to move.
All right. Thank you so much, Mayuresh. Great to have you in the studios and hope to have you back here soon.
Oh, absolutely. The pleasure is of mine. Thank you so much. And you guys are doing a fabulous job.
Thank you.
Closing thoughts, Manoj, from amongst the names which are doing well, OMCs have a bit of a spurt today. Would you trade them?
Niraj, see the rationale here is because of the bank Nifty expiry, obviously the money is all there. You will see more traction there. But then, yes, if I have to still take, we are seeing some short covering in IOC. The stock is closer to 119. So that still becomes a good buy with a 116 stop loss. The stock has a potential of 126 to 127, but that's a positional call that we'll take. Again, the Bank Nifty futures, I guess it's almost at 47,200. So we still about buying that with a stop loss of 200 for a target of 47,500.
Right. Thank you, Manoj. Those are a few stocks that are on Manoj's radar this morning. IOC on back of fruit play is trading the gain of 1%, and that's a counter Manoj likes. But I think the bigger story is on India and will remain on India. We've got a report coming out from Morgan Stanley and what they have in terms of the outlook on Indian equities. Niraj, what are your key takeaways? Morgan Stanley quite constructive on India at this stage?
You know, you have to argue that Ridham Desai and team got it right when they turned constructive about few months back, and that has paid off well. Now they've come out with an Outlook 2024 report, and it's interesting, the few takeaways. He starts off by saying that it's hard to argue against India's investment case. That's the key point. Even if you wish to, you cannot make an argument against India investment case. And the strong earnings, macro stability, and domestic flows. You know, it's amazing that every note now talks about how domestic flows are a key pillar which will aid the market momentum almost every single year, and Morgan Stanley is no different there. Now, what are the key takeaways for 2024? According to them, the long-term story is gaining strength, and India is the key pick in the EM and the Asia-Pacific basket. They say base case looks for improving absolute returns and outperformance to the emerging market pack. And they say general elections, amongst other events, point to a bit of higher volatility when it comes to India. So that is probably the one thing, that volatility may be higher, but otherwise things look promising. Now the base case for markets, they say they expect equities to rise in 2024 general elections as the market, in the lead up to the general elections, as the market is likely to price in continuity and a majority government. They believe there is a 14% upside to the BSE Sensex up to December 2024 as the base case. Now, you remember, viewers, yesterday we had BOFA come in and talk about how the risk reward is skewed in favor of gains, and they believe there's a 15% upside. So there's a bit of a consensus out here from large global brokerages about what the Nifty could do in 2024. The thing is, everybody seems to be biased towards large caps as opposed to mid caps. So when it comes to Morgan Stanley, they are saying they prefer cyclicals over defensives. So you would see a bunch of those LNTs. I don't know if metals come into play here, but largely people stay away from metals because they are globally exposed. But local domestic cyclicals and cap goods come into play out there. Real estate comes into play. So that's the set of stocks that people are preferring as opposed to defensives. REIT staples, and large caps over the SMIDs is what Morgan Stanley is saying, and this shouldn't surprise anybody as well, which is why, in fact, we've such a sharp focus on the SMID show. And lastly, they are overweight financials, consumer discretionary, industrials and technology. They say they are underweight every other sector. Just before I wrap up this piece, the other interesting thing that they are saying that the key drivers for a structural bull market for India include macro stability, secular positive BOP. So that is part one. And a lot of people are penciling their focus on the balance of payment situation improving in India. Secondly, they say that strong relative and absolute growth for India. So not just in absolute terms, but even in relative terms, they're so much better than any of the other economies, large economies, which may be growing. Reliable domestic sources of capital. India's 401k moment. So everybody's talking about that as the third piece. And two more drivers that people talk about, social equity, and lastly, consumption boom. We haven't quite seen the consumption boom come into play as yet, at least at the rural side. Maybe that comes to the fore in 2024. So that'll be interesting to see. But net, much like BofA Securities, Morgan Stanley too constructive with about a 15% at the start of the year. And by the way, 15% on large caps is not a bad play if we believe that the markets, that will keep the market steady, and then therefore individual stock specific stories will keep on buzzing.
We've talked about this, Niraj. This is really how things have also been playing out on the ground. Markets, like we said, are having a quiet morning, so the broader market's also trading with a negative bias. The Nifty 50 is trading with an 8-point gain, not much to talk or write home about. Some of your metal names are looking good. OMCs, paint companies, and stock-specific action is really what's driving today's trade. We'll take a break, but when we come back, we will talk to Vikas Khemani, founder of Carnelian Capital Advisors, sharing his views on the bull run. And we also have with us Vibha, management of HDFC Life, MD and CEO. Vibha Palekar of HDFC Life joins us on the other side. Welcome back. It is a quiet day of trade. The Nifty is trading with marginal gains, but a quick check on the top headlines that we're tracking at this hour. Markets open below 20,900 and trades with cuts. Nifty Bank, PSU banks and IT stocks under pressure. Broader markets outperform the benchmark. Nifty IT top lagging sector indexes on the index as stocks like TCS, Infosys, Drag, Eicher Motors, NTPC and BPCL gained the most. Adani Group is in focus as the group plans to invest $100 billion in energy transition in the next 10 years. And Morgan Stanley makes a strong case for India, eyes 2024 general elections and expects a 14% upside to the BSE Sensex. And from the primary market, stationery maker DOMS and Nexus Ventures backed India Shelter Finance Corporation IPOs open today. Both the companies have a total offer size of 1,1200 crore rupees. Well, that is, of course, the top headlines we are tracking, but we have with us a very special guest in studios. Vikas Khemani, founder of Carnelian Capital Advisors, joins us. Vikas, such a pleasure to have you in the studios on this very significant week for NDTV Profit. First up, how are you feeling about the market? Some may argue it's expensive, some may argue there's still value. Morgan Stanley, of course, fairly constructive on the road ahead. Where are your bets?
First of all, thank you very much for having me in your studio, and congratulations on the launch or relaunch of your channel. So I'm quite positive on markets. Frankly speaking, I don't subscribe to the camp that markets are expensive. I think, given the India story, given the potential growth, markets are not at all expensive. They're in a fair value range. They are not cheap, but I don't think they're expensive either. And I always believe the valuation is a function of three things: ROE, earnings growth, and discounting factor. If you see, India's ROE is one of the best compared to any other market or its historical time. Our earnings growth are 15 to 18% sustainable for quite some time, at least next 3 to 5 years. It looks like that. And thirdly, discounting factor, which in turn is a function of risk-free rate and risk premium. And if you look at both, risk-free rate is probably lowest ever, given the difference between US and India 10-year paper, and our risk premiums are coming down with whatever comfort around Indian story is there. So here is a very interesting trivia. We all understand, in case of a fixed income, that if a 10-year paper with 6 duration, a 2% drop in the interest rates makes the fixed income paper appreciate by 12%. A 2% drop in the interest rates with a 6 duration paper, paper will appreciate by 12%, but it's not that intuitive to understand in case of equities. So if a 2% drop in the discounting factor, the DCF value, everything else remaining same, changes by 35%.
Oh. Wow.
So if, let's say, there are nuances to it, but I'm just giving a broader range. So if earlier 20p was fine, with a 2% drop in the interest rate, your 27p also becomes fine. I'm just giving you this context. So I do believe that we are not expensive. I think, of course, markets will be subject to sort of volatility, intermittent corrections, but I don't subscribe to the camp that, in fact, if markets were to trade cheaper with this kind of setup, I would be really worried about the hypothesis.
I mean, emerging markets are trading at a 50-year high valuation. So that, of course, is something that we can talk about in detail. But yeah, we look well structured in place for now.
Yes.
What about, the big sort of X question, or the joker in the pack, in the sense? So everything else is aligning, crude is benign, treasury is fine, US recession seems like yesterday's headline, and political stability is there. But we don't know what the Fed's going to do. We don't know whether interest rate cuts are going to begin. How big a factor is that in this horizon that you have painted for us? Very positive picture you've painted for us. What is the capability of this one factor to spoil that party?
So I think one thing, Tamanna, is very clear, that interest rates have peaked out in US. I don't think there's a further scope of going up. You might argue, the question to ask is when they will come down. I don't know. It can be 6 months, 12 months, 24 months. But they are definitely coming down in that time frame, right? So I think worst is behind us. If, let's say, they come down in 6 months, or they start coming down in 6 months, then we will have probably a lot of flows coming earlier. If they come down in 12 months, slightly later, but doesn't matter. The point is that, whatever $45 billion of outflow we had over last 2-3 years, because Fed started raising interest rates, all and more will come to India the moment that reversal happens. And that period is anywhere between next 12 to 24 months. I don't know the precise time.
Yeah. But the question is that, and I'm saying this from the point of view of a large number of retail investors who have just come in, and not just the mutual fund pack, who are coming in, looking at the markets right now, seeing maybe some of the investments running up, wanting to put more money and wondering what to do. Do they have to wait for a correction, for a crack? Is that round the corner as an opportunity to come in? Just, if someone just came up to you and said, Vikas bhai, abhi kya karna hai? What would you say?
I will say deploy, invest, because unless your time horizon is 6 months, I don't know that. Because 5-10% correction can come into market at any point in time. Nobody can tell you when, how. You run the same risk when the index is 18,000, 15,000, 21,000, right? So that you can't. But if your horizon is 5 or 10 years, I don't think one should worry. There's a very nice saying by Peter Lynch that more money is lost on waiting for correction than actual correction. A lot of people miss out on waiting for correction. When you have this kind of setup, like you said, everything seems to be working well.
Yeah.
I don't think at least next 3 to 5 years perspective, I think India, or forget that. In fact, even from longer term perspective, I think next 10-20 years are very well planned for very well disposed for India. And India is one of the best market globally. So if you are living fortunately in that era in this market, all you have to do is just keep allocating whatever capital, towards equities and asset class. And we are still, as a society, significantly under-invested. Funny part is that we all make statements, so much money is coming. But I'm saying still we are significantly under-invested as a society, in compared to our overall household savings. So long way to go. I don't think we should, every time things start working out, we start getting worried. What can go wrong? I think we can just enjoy the journey.
As we should. But Vikas, thanks for
journalist in you has to ask, but
we have
no. In fact, I'm asking the but with a very specific purpose, which is this: that your fund performance, for example, the last 3 years has been spectacular. Some of it might have been bent towards the broader end of the spectrum, which has done tremendously well. So the but comes in is there merit in chasing the broader end of the spectrum now? Or do you believe that even if the markets stay constructive, maybe the tilt might be towards large caps opposed to mid caps and small cap themes in 2024?
No, absolutely. See, Niraj, these kind of intermittent, changes will keep playing out. Sometimes large caps will do well, sometimes mid caps will do well.
So what is it for 2024? You think?
I frankly speaking believe, I don't subscribe to some of those large and mid cap kind of allocation.
Okay, you don't.
I do believe that all you have to do is remain invested into high quality business run by great managements. And if you like the business model, if you like the the team or management team, I would rather buy a company small than big, right? Because that is going to give me a significant compounding effect of 5, 10, 15 years. Not to say that you don't have great ideas in large caps as well, right? We have had one of our biggest winner, ICICI Bank, which is a large cap over the last 4 years. It has run 4x, right? So whenever you see a good risk reward setup, whether it is large cap, small cap, mid cap, you have to just invest. So we keep hunting for that. Of course, having said that, if large caps have underperformed in recent past, you might see a temporary outperformance in 24, 25. But over a 5-10 year period, I have no doubt that small and mid cap will outperform large cap, because in a structural bull markets, in a structural economic revival, it is the wider market which does well than the index.
Okay. And so let me then try and understand how is, since we are at the end of December, virtually at the end of December, Outlook 2024, I'm trying to understand where is it that Carnelian is placing its largest bets on? Because one way is to ride the winners, one way is to try and bet on changes that are happening within a structure or a sector, and earnings growth might be strong in the future, if not in the past. Where is it that you are most overweight on?
So I think, there are 3 or 4 sectors, themes we've been very, very overweight on. Of course, you cannot not be bullish on BFSI in this kind of setup, right? Within that, we've been super bullish on PSU banks in the recent past, and in last, 4 years of our history, last 1 year or so, we've been a lot more, only last 1 year we bought PSU banks, and we think that there's a lot more steam to go there. So BFSI is a space we like, no doubt on that, and that will continue to do well over the next 5-10 years. I have zero doubt on that. Manufacturing as a theme we are super bullish. As you know that we have a separate dedicated fund which we launched in October 2020, 3 years before, right? And that fund has delivered 47% CAGR over last 3 years. We think that over next 10 years, manufacturing as a theme will do very well. And when I'm saying manufacturing as a theme, I mean is what sits between on import substitution and export-oriented opportunities, typically non-commoditized player with 50-60% kind of gross margin, those kind of niche businesses, which we believe that in fullness of time, 5, 10 years, 15 years, will become multi-baggers. Already they have become, but there's a lot more steam to go in times to come. I mean, it is very much similar to where IT was in mid-90s. So, that's the kind of conviction we have on the theme, and we think it's a long way to go. So that's the second sector we've been very, very sort of bullish about. Thirdly, IT as a segment, I mean, we've talked about again many times over that we're very positive despite a lot of skepticism, despite lots of negativity. People don't believe that. We've been very, very bullish, convinced, and still remain convinced on the IT as a segment.
You put in fresh money to work in IT?
Absolutely, I have no doubt on that.
And
I think
it will. Where would that money go? Large cap IT, or you would still remain bullish on mid cap IT?
Like I said, we've been more bullish on mid cap IT.
Yeah.
I mean, this year, 23, despite through the year, we've been told that IT sector will not do well. Most of our stocks are up between 50 to 200%.
Wow.
So especially large and mid small cap, mid cap IT. But we think that every cycle of a journey, many companies get created. So if you remember 2009 to 14-15 cycle, HCL Tech, LTTI, LTTS, all those companies got created in that cycle. They were tiny minnows that time. So in this cycle also you will find similar kind of companies getting created. So our objective is to look for those companies which can become
Which ones?
Which can, I mean, for that you can look at our portfolio, but I'm saying you have to identify companies in that space. And I have no doubt that many companies will become large and large in this journey. So IT is another space which has been very bullish. Then you can keep finding, so far still we have not, last 4 years, I must tell you, we have not bought many consumer names. We've been not very bullish. This is a consensus trade, but we have not bought because we think risk reward has not been so great. And still we are on a sidelines. Whenever there's a specific name or company comes, we don't mind buying. Yeah. But as a theme, we have not been still optimistic about.
Talking about exports, you mentioned mid-cap IT. How do you feel about pharma? Because I know a few months ago you were constructive on the pharma space. The international marketplace has improved. Things seem to be working in the favor of the sector for the next 5 to 6 years. How would you play pharma? Do you like any of these pharma names currently?
Absolutely. We are very, very bullish on that also. And partly we covered that in our manufacturing theme. But yes, you're right that, we have been very bullish. We spoke about it, I think pharma over the last 6, 7, 8 years have not done well. And now the tide has turned. It has changed. You know that recently the first time US regulator was in India visiting for 10 days, meeting all the pharma companies. Why would they come here? Because recently there was shortage of medicines in US. And we know that India is one of the largest supplier of US medicines in US. So tide is changing. I think this tide is changing for at least 5, 7 years. Within pharma also, CDMO space is a super high growth space, like how in IT, ER&D is. That's how, you see CDMO is a great space. And you will see many companies, I'm telling you today, many companies 5, 7 years down the line will be 1 lakh crore market cap in this space. It's a very big emerging space. And this segment you cannot ignore. And this is very much like, in some sense similar to IT, where it requires a lot of, founder-driven, a lot of focus on. It's not an easy business to do, but it's a very good, sustainable, long-term business.
Your take on public sector companies, even today. They are really top of the charts, PFC, HPCL, REC, all, it's sort of a rediscovery that these companies can also perform, their valuations are decent, they can undertake the work that they promised to do, perhaps without policy interference. Have you put your faith in any of these or in this space, and do you have an outlook there?
Absolutely. So we don't sort of treat PSU as a space with the same approach. Our approach is wherever, first of all, we must give credit to this government that the interference from the government is almost zero in most PSUs, right? But not on all, right? So let's say for that matter, HPCL, BPCL, we still don't have, full pricing, right? So you have to understand where the government's intent is. So for example, we've been very bullish on PSU banks. Why? Because government interference in PSU banks is very, very negligible or no. But more importantly, I think big 3 transformations have happened in PSU banks, right? Asset quality. There were 3 problems for PSU banks: asset quality, governance, and technology. If you've seen last 3-4 years, asset quality problems have got addressed, governance has got addressed. They merged the banks, and they've got, I'm telling you, government has appointed very, very fine, leaders across as a CEO of these banks, and they are driving transformation in these banks. And thirdly, if you see technology, it was a very big differentiator 15 years ago because every company had to build technology. Today it is all plug and play. So most PSU banks have spent a lot of money in building, spending in getting the technical capabilities. So today, even a PNB person will come to open your account with a tab. He doesn't come with a form. So today, even most PSUs are reasonably well technology enabled, just like private sector banks. So if you have these three problem matters, there's no reason why a PNB, which has, or any large bank for that matter, huge amount of customer base network, should at 18-19% ROE should trade at one-time book, versus a private sector at 2.5-3 times.
Right? So the experiential difference or that gap has definitely closed.
So that's what I'm saying.
Where you had a sense that PSU Bank is going to be a bad experience. Just a word on all the fundraising that they are doing. And a slew of them already raising money. Some more are going to, the market is rewarding them in advance of that fundraising also beginning. How are you positioned on that?
No, but they are doing it because government stake has to bring down. And they don't need capital right now.
Yeah.
But they have to do it because government has to bring down below 75%.
So it's an opportunity?
It's an opportunity. I mean, we have no doubt on that. According to me, we have a massive opportunity ahead of us in PSU, banks per se. And likewise, you can look at other PSU sectors like defenses, for example, a great, opportunity.
But still, Vikas, after the run-up that we've seen already, it's so thematic, right?
I can only tell you one thing. When you look at 10-year, I have seen stocks becoming 15x, 20x, 30x, 40x, right?
We're still far, far away from that.
So this is like a long journey, right? And defense as an opportunity, we have just scratched. I'm not saying that there are no excesses. I'm not saying there are no exuberance. So you have to do your work and job.
Yeah.
I'm not making that point. But defense as a theme is a 15, 20-year theme. But you have to do your work at a company level.
Got it. Because just two quick things. One, follow-up to the answer that you gave. Private banks are no longer as expensive as they were. HDFC, Kotak, etc. PSU banks are cheaper, yes. Between the two, the chance for a higher delta is still in PSU banks, or do you reckon private banks too?
Absolutely. See, like I said, private banks also will do well, but PSU banks will outperform because there's a chance of re-rating. You will have earning growth and re-rating. So that our magic movements are happening in the PSU banks right now. So we think that PSU banks will get re-rated further.
Okay. We have Vibha Padalkar coming up next. Just wanted to understand insurance. I was seeing the returns since 2017 hardly performed, right, per se, despite the fact that some of these are great businesses. She runs a very fine HDFC Life business too. Is there a chance for money to be made here, or are there better opportunities elsewhere?
No, absolutely. I think life insurance is again a very big sector, good sector. Typically, you will always have periods of consolidation and periods of growth. So I think life and general insurance has gone through a, last 5-7 years period of consolidation. And so that has led to, and there were some regulatory changes also, marketplace changes also happening. So that was there. And secondly, now they were trading at a premium, which is kind of corrected. Because see, if you see 2009 to 14-15 period or 16 period, when there was a lot of uncertainty, there were very few playable or investable companies, including HDFC Limited or Kotak, and that made them expensive. But today, same money is going and finding opportunity somewhere else. So the thing is that is leading to re-rating on the other opportunities, but de-rating on the expensive ones. And that journey to a great extent is over. But now, wherever the growth comes, you will see. So it's more like an earning growth story. And all these are great franchises. So I think you should expect a moderate 14-15% return. You should not expect a spectacular return. If that is your expectation, then you're better off in manufacturing and somewhere else.
Also, just a follow-up to that question, what about banking in terms of financial ancillary names? So what about brokerages, investment banking? You've seen the primary market that we've seen currently robust, to say the least. That, of course, would reflect on, companies like JM Financial, for that matter, or brokerages or even exchanges. Would you also consider this a space that one could sort of make money in?
Absolutely. Again, see, when such a large saving pool is getting intermediated, and it's very natural that capital markets are a very big part of it, right? There are different ways of that. So the entire ancillary space will do well.
But in this ancillary, if I had to ask you to point it down, bring it down to one ancillary play, which one would it be?
I think asset management, wealth management plays are very good because they have a natural compounding built into that. And if you say India is compounding at 15%, that much growth is anyway built into their assets, right?
Bare minimum that they will do.
Bare minimum they will do. So like for that matter, the reason why I prefer those players over insurance, because there's inbuilt compounding and then the growth. So if you get a good franchise, then you can have a double engine or double acceleration. I always like a little bit more acceleration given the same risk.
No, that space is actually
consolidating
pretty well, actually. There's so much activity. I mean, you look at even primary markets, your likes of GM Financial. I can't wait to see what those earnings are going to look like soon.
Stunning. Yeah. But anyways, Vikas, great to have you. Thank you so much for taking the time out and being with us in the studios, and look forward to having you more often.
Pleasure. Thank you very much for having me. Enjoy the conversation.
Yep. Thank you. We did too.
We'll take a very short break, but stay tuned. Up next, we'll be speaking with Vibha Padalkar, MD and CEO, HDFC Life Insurance. Don't go away.
Back with India Market Open right here on NDTV Profit. Now, life insurance data that came in, certain insurers had a weak growth in individual AP for the month of November. However, individual new sum assured growth was strong for HDFC Life. More importantly, the question to our guest coming up is whether insurance businesses can show growth and strong double-digit growth over the next few years, especially after the tax changes that have recently happened. Ms. Vibha Padalkar, she's MD and CEO of HDFC Life, joins us right now on the show today. Ms. Padalkar, great having you during our launch week. Thank you so much for taking the time out and being with us. Hope all is well.
All is well, Niraj, and hearty congratulations on this beginning of a great new venture of NDTV Profit.
Thank you so much. Need you to come more often, must say. But let's start off with your broad brush view, Ms. Padalkar, on how do you see growth within insurance for the next few years? Because maybe companies were chugging out a fine trajectory, but then there were some tax changes, and while it may not have impacted the ticket sizes as much, there are question marks in the mind of the investor community about healthy double-digit growth can possibly be sustained over a period, never mind what could happen in a quarter or two.
I have no doubt in my mind about what you're asking for, and this is why I'm extremely confident about these levels of growth. Reason for that is nothing fundamentally has changed. Insurance and tax, while that might be a conversation opener, when you look at all the numbers in terms of low levels of penetration, when you look at demographic changes, disintegration of or evolution of from a joint family to self-sustaining mode, people living longer, health requirements only going up, health inflation continuing to be relevant, new lifestyle illnesses being there, pension increasingly understood as a necessity that people, the Sar Utha Ke Jiyo hypothesis. All of that means that nothing's changed in terms of the opportunity. And as our per capita GDP continues to move upwards, that inflection point, as we are beginning to see, will happen. Yes, there might be some twists and turns here and there that we have continually seen in our sector, but these are all growing pangs. And hence it leads me to believe that double-digit growth as well as many new opportunities. It could be as composite license, it could be as a step-down subsidiary in the insurtech space, it could be distribution of other products other than life insurance, similar to banks. If banks can distribute, why not life insurer and other insurers, so that we are really sweating every touch point of our distribution to reach the last mile. So hopefully that answers your question in unequivocal terms.
It does. So Vibhaji, so the tax sort of change came. You're saying it was just a footnote, a conversation piece, and then a lot more happened after that, including the Exide deal and taking over. Can you just tell us how that is panning out and how you are setting your sights on the entire landscape right now? What kind of a push is also coming with a very clear policy focus on increasing the penetration of insurance in this country? And how does a player like HDFC Life stack up in that broader picture?
So on your first part of your question, the first M&A in the life insurance space, done and dusted, and we were quite, I think, brave to venture out into this during COVID period. Also, thanks to our regulators, we were able to get approvals, various approvals on time, and now the two businesses are enmeshed, and the erstwhile business that we acquired is growing very well. In fact, as of today, it's growing faster than rest of HDFC Life. While we're no longer tracking it separately, like I said, it's enmeshed, but it's growing faster. So the very reason why we did this M&A is more than obvious in terms of top line growth, in terms of focus on tier 2 and 3 towns, as well as focus on aspects like protection in the non-salaried segment. For example, today, the erstwhile Exide Life channels have reached a protection percentage of whatever they sell at about 12 to 13%, which is double the company level protection number. So many such metrics of making inroads is there. Cost synergies are also done and dusted. So really the merger has now completely fructified in the manner that we envisaged. So that's the first part of your question. The second is in terms of how do we expand the pie. Thanks to the regulator, many things are now an opportunity and becoming a reality based on also what HDFC Life has in mind. All of you are aware in terms of India and all the states of India being distributed amongst all insurers, both life, general and standalone health insurers. We, for example, have amongst other states also Gujarat. And working at a grassroots level, this is through the products of, at a composite level. So it's a one-stop solution, grassroots level, being sold or would be sold through women as a village level entrepreneur. So that's starting from the bottom. Also, when you look at the other aspects of ecosystem, which regulators talked about, Bima Sugam, and this would be wherein it's a platform, and insurers can directly offer solutions to end customer. It can also go through a distributor, not very dissimilar to mutual fund. And the whole intention is that people can directly connect with insurers, the manufacturers on a digital ecosystem. What do we get for it? We get to connect with the customer. We also get very rich data, hopefully, so that we are able to give a very bespoke underwriting, bespoke offer on the table. And from the customer's point of view, there is complete transparency, can compare, and so on. These are all very path-breaking opportunities that will pan out over the next 12 to 15 months. Last point I want to mention as to what keeps us busy, apart from these, is that we are the first ones to open our presence in GIFT City. And we have already launched and doing well in terms of dollar-denominated products. So we have started off with a student plan in dollars. We are on the cusp of moving on to a health plan, and then we'll also move to a retirement plan. So these are the focus segments for the NRI population. And eventually, hopefully, also LRS will be allowed down the line. We will continue to engage with the regulators. So many, many new opportunities. Last point is the draft insurance amendment bill, which hopefully, as and when it sees light of day in terms of changes, that should hopefully give us opportunities to come up with a lot more innovative products and solutions.
Ma'am, just because you talked about the digital portion of it and the moves made there, just to understand, what is the proportion of pure digital onboarding right now?
For us, onboarding is close to 88%. So the way we see digital is not just as a vertical or a channel. It's now ubiquitous. It's across all our channels. So even a more traditional channel like a proprietary channel, largely the onboarding is through digital means. There's very little of non-digital. However, there's very little of end-to-end digital. So you'll find that in our own website or direct touch points, but that's about mid-single digits. This should increase as we start engaging with millennials. But even if you look abroad, end-to-end digital for a higher ticket size, more advisory based, I think it might not pan out. So some level of advisory, some level of self-serve, and so this phygital model is how I see this, at least in the medium term, and that's perfectly all right, because you do need some level of customization to one's own needs, and hence part advisory, part digital model is how I see things panning out over the next 3 years.
The retail protection business for HDFC Life clocked in growth of nearly 45%. Is that momentum sustainable? And also demand for annuities, will that also increase with more NPS subscribers retiring over the next decade? It'd be great if you can share some data with us on that. What is the sort of outlook we have on the protection and the annuity business going ahead?
On the first point on retail protection, we see this as a big opportunity. We all know about the large protection gap, over 90%. We also know about what the pandemic has done to us in terms of people understanding that not having adequate levels of pure protection can possibly wipe out a family by a generation. So people are no longer asking as to why do I need it, which they used to ask maybe 5 years ago, or they used to say that this is a cost, nothing's going to happen to me. Now they're beginning to have conversations on how much do I need, what kind of products should I look at in terms of pure protection, and so on. So this is a kind of healthy journey that an average Indian is moving towards. And that's really what the numbers are showing, of between 40 to 50% growth. To your question on sustainability, some of this is base effect. However, I do believe that protection will grow faster than company level growth, as a result of which you will find that the share of protection will continue to go up. And in the medium term, like I mentioned earlier, in our agency channel, touching about 12 to 13%, company level should touch those kind of levels over the next 3-year kind of time frame, as more and more people and younger people come into the pure protection net. It'll take time, but I think that journey is inevitable, also with rising per capita income. As far as retirement is concerned, worldwide, pension funds are the largest asset pools and also fairly sticky. And I would envisage that our step-down subsidiary, which is HDFC Pension, that has crossed comfortably 60,000 crores of assets under management and perhaps larger than a lot of financial institutions, will continue to be a compounder in terms of their AUM, and compounding at anything between 40 to 60% kind of a growth rate annually. And we are the market leaders in this space. We'll continue to do that. What this does is this is a feeder into the parent company, which is HDFC Life's annuity business, because insurance companies are the ones that can give annuity that require large amounts of capital and hence reserves to write guarantees against that. So that will be a feeder. Stickiness is there. More and more people are coming into this net as we project it forwards. Government employees, that's another big one. They are increasingly comfortable looking at performance to move towards non-government, both accumulation as well as buying annuities from. So all of this, we are at this inflection point to catch a lot of this demand coming through. And I'm of the personal belief, while there's a lot of focus on protection, but I'm of a belief that actually pension and retirement solutions will become even more topical as an average Indian outlives their their retirement age by maybe 20, 25 years, and given where inflation is. So the risk of outliving one's savings is going to be more painful than perhaps even dying prematurely. Both are important, but the size is going to be very huge in terms of the opportunities on pension and retirement. So that continues to be our focus. But the point is that this is the tip of the iceberg. All of us in the sector need to expand the pie, and really that opportunity is there.
And as you always said, do so responsibly. Without there being errant competition. Just wondering, Ms. Patel, keeping all of these factors in mind, would you reckon that, one is what the business has to do and what the business will do and the country will do. Two is what the business metrics can show. So with all the factors that you've said, and considering that there have been tax changes, which a lot of people, while you say it's a footnote, but for a lot of people in their minds it's still landmark, do you reckon that APE growth of 20-25%, VNB margins northwards of 25%, inching closer to 30, as you probably earlier had, if I'm not wrong. Do you think these are possibilities for the future?
I would say our track record of consistently doubling every metric, top line, bottom line, embedded value, assets under management, and more than doubling on protection and retirement, we should continue with that track record, absolutely.
I just want to quickly get your views on this, and I'm sure you've talked about this quite a bit. What about the merger? How is that, of course, apart from the operational shift that we've seen, how else are you expecting this to impact business going ahead in the medium term?
So HDFC Bank is our parent now, and so there is also alignment in terms of our largest distributor also being our parent. And the closer working of not just us with our parent, but also our parent with other subsidiaries is clearly happening as it should. They have also articulated this. And from a bottoms-up perspective, while they have articulated that there will be open architecture, nevertheless, as long as we are the product innovator, we give the best service. There are 61 points that they track in terms of a holistic proposition to their customer. As long as we are right up there, I think market share will continue to go up because that would be the rightful way. And we've already demonstrated 600 basis points increase in our market share since they've become our parent. So we have to continue with being recognized as an innovator to give the different product solutions to HDFC Bank's customers, be right out there from a tech solutioning perspective, have trained presence at their branches and their branch expansion plans. With all of that, I think these synergies will continue to only increase. Also, the last point is from a group's perspective. How do they better service their customers? Because now with customer consent, they will have an end-to-end view of who this customer is, what their preferences are, what state of propensity for them to upsell, and so on. Only that can increase, and that's really as a group what we're working on.
Vibhaji, I was hoping we could talk a bit about business outlook as well. You've said you are positive on H2. It's going to be even better as far as H2 growth is concerned. I'm wondering if we could get some more details on that. Why do you think that's the case? What is your premium growth outlook for FY24 as well? And if you could just add some insight on how you see the business growing and the numbers.
Like I mentioned, this year is one wherein after being hit by a truck from a tax perspective, the entire industry is making that change towards the core of what we stand for, which is in terms of risk management. I've articulated mortality, I've articulated longevity, as well as solutioning that no other financial product can give, which is long-term fixed outcomes, very long term. We're talking about 15, 20, 25-year kind of predictable outcomes in terms of guaranteed products. So I think that shifting, and that when we look at it in a little bit more nuanced basis, below 5 lakhs continues to grow in terms of number of policies, in terms of inherent demand. Similarly, tier 2 and 3, which are relatively less affected by the tax changes, that is showing healthy growth. As expected, the wealth channels have shown a degrowth and continue to be a degrowth for both us and the industry. This is I'm talking about in other than unit-linked products. That will grow. That will continue to grow. I'm of the camp that it's a question of when and not if that segment will start coming back because of some of the product solutioning that only life insurers can provide. So while we wait for that machinery to turn, what we have said is double-digit growth, double-digit level. We are still gunning for those numbers. And if you were to look at number of policies, so if you just the last couple of months, the number of policies for us has seen a growth of 13% and market share continuing to go up in number of policies. So what that means is that we are able to engage with more and more customers, which was not the case, admittedly, for both us and the sector over the last 3 years before the tax changes. So the engine and the machinery that is changing is to connect with more and more Indians, to move more and more inwards into Bharat, so that you're engaging early, you are also solutioning it for them, you're also solutioning it from non-standard income proofs, non-standard other KYC. Similar again to NBFCs that are and banks that are in that geography, piggybacking on both HDFC Bank and several other banking partnerships that are opening branches in non-tier 1. So all of that means that we continue with a positive outlook. In fact, the sector was expected to deliver no growth this year, and I think both HDFC Life as well as the life insurance sector overall has positively surprised by giving just a little bit shy of double-digit growth. But I think if you look at, for example, number of policies, we've already crossed the double-digit threshold. So that's how I see this year panning out for the next few months.
I'm glad you talked about the industry because that really does bring me to my next question. We've seen continuous disruption in the sector. Online policies, JV splits, foreign players coming in, exiting early, perception of the front end on push, having started a little bit on the wrong side, maybe a little more aggressive. When do we see stability equity and prospects of the industry now playing out? Do you think the time is now for things to start showing signs of easing?
I would put this down to growing up pangs, because for us to get to the seniority of say banking industry that has been around for a lot longer, most of this upheaval is for the good, wherein the industry will become increasingly resilient. So if you were to look at, for example, FDI, if you look at some companies, including us, listing, if you were to look at regulatory disclosures, and so on, and the business models evolving. COVID was another one wherein over 60,000 crores of claims the industry has settled, and largely we are unsung heroes, if I may say that. We settled that without a murmur, often with insufficient documentation, just because that was the need of the hour. So all of this means that the sector is becoming increasingly resilient. And last point is that with every upheaval, the larger companies, including HDFC Life, have actually become stronger. And if you look at one of the slides in our investor presentation, you will see that actually market share has increased with every disruption. So we are not afraid of disruption. We embrace it. Our business model has to be strong enough to both anticipate as well as take opportunities that disruptions bring in. And that's how we see this. But yes, to your question, largely, most of the changes that have to happen are out of the way. We do hope that there is some relaxation in terms of the 500,000 level in terms of taxation. But whether that will happen or not, I don't know. And only reason for my asking that is the levels of insurance penetration are still low. It is still a young sector, not yet completed 25 years of life. And like you mentioned, a lot of disruption. So a little bit of sweetener there will only help in increasing penetration levels, at least for a few years.
Is that going to be a pitch to Madam FM in the next couple of months?
It's going to be an appeal, yes.
Okay, an appeal, that would be the right word. Vibha Padalkar, absolute pleasure speaking with you, and you're right, the industry has been a hero post-COVID. There's no doubt about it. When people were in pain, the way you have also steered the ship of HDFC Life is completely commendable and has been recognized. Thank you. It's been a pleasure speaking with you today here on NDTV Profit.
Thank you so much. Thank you for having me.
We'll be taking a very short break, but on the other side, we are going to speak with the management of DOMS. The pencil makers IPO opens today, and my colleague Sajit Mangat has asked them quite a few tough questions. So stay tuned for that interview after the break.
DOMS IPO is open today. If you want to subscribe to it, hear out this conversation that the management, the founder and the CFO of the company had with my colleague Sajit Mangat earlier.
Is there a commercial arrangement that you have with FILA with respect to how much of of your manufacturing products would be taken every year with and taken by FILA and distributed across various geographies?
So, as I already briefed that we have always been very conscious about our Indian markets and where we want to grow at our topest priority, and this is our collective decision. So we don't have any agreements in place, but yes, over the period of time, we have all been working on growing our mutual synergies and trying to reach out to FILA's expectation needs from year on year.
Okay, and you see this business growing at a same level as your domestic business, or is it be a gradual organic growth there coming for you?
So basically, for us, keeping a well balance between both the aspects is very important from the business point of view. So we have always been very conscious in bridging this particular factors where our export business with FILA, also our export business with our DOMS customer, and our business in general trade, modern trade, and e-com platforms grow in a very balanced form across the channels and over years.
Mm-hmm. Rahul, how do you manage pressures from suppliers, because that's something will be increasing every year? How do you manage? Is there a way you can hedge it, or is there a way you can pass on the cost across to the consumers? Because that's a segment which is a very price conscious and price sensitive segment, right?
Honestly, over the years, what has happened is the product has become important, the brand has become important. Today, we have been able to provide a very differentiated product range to our consumers, coming up with new innovative products always. This is why they are appreciating the product. And whenever we see any sort of escalation in prices beyond a level which can be, borne by the company, we are, as a brand, as a company, very conscious to this fact and increase the prices of the product at the consumer level or in the channel. And considering the brand has now become so important for everybody, we've never faced any resistance. Therefore, you'll see our average selling price over the last couple of years have increased.
And that's the reason why margins have also seen improvement every year.